Good times. Good way to start the year. All right. Happy New Year, everyone. We're starting the year fresh here with another episode of Money Tree Investing Podcast. I'm here with my good friend, Doug Hagren. Hi, Doug.
Good morning, Kirk. Hey, it's a new year, but some things never change. Tech issues, right? Getting
Yeah,
things right. Hey, you know what? It's just proof that this is real. We're intentional. Things happen, when you're live, can't edit through reality. So
That's true. That's true. Well, let's kind of dive right in, and hopefully, how was your holidays, Doug? I mean, we all get a little time off, or hopefully you did. How
yeah,
were your holidays?
took a little bit of breather, spent some time with family. We learned years ago that this habit of trying to make everybody else's Christmas and run from house to house to house is absolutely insane, and it doesn't really work well for anybody, especially kids. So we had some people come to us. We did one New Year's Eve thing with the family. Then, as I was kind of telling you off camera, Kirk, I'm a tennis player. I love playing tennis. Played it since I was little, but aging sucks. So, we're out there. I've got a Tuesday morning clinic, and I decide to kind of go for a ball, and all of a sudden, bam, muscle tear, pop in the leg. So, resting a little bit, probably good timing to be a little bit down, and not run around so much because I could barely stand anyway.
So it sounds like you've got a great excuse going to the new year for not pursuing your New Year's resolutions, Doug.
Absolutely. And I think it's going to be like, I'm not going to exercise, or do much, anytime soon, stretch anytime soon. I'm going to sit around and eat bonbons and, fatten up because, that's the way to health, I think. Good. Auld Lang Syne, everyone.
Well, it's interesting because we all kind of go into the new year and we all come in with these habits that we want to create, and we're going to turn over a new leaf. And for this year, I'm going to lose weight, or I'm going to exercise more, or I'm going to eat healthier, I'm going to drink less, I'm going to whatever it is, right? You're going to make more money. Everyone comes in with these really high, lofty goals of what they're going to do this year, which is great. And inevitably, two to 3 weeks in, we all fail. And we do it for the same reasons, right? And I want to talk about this a little bit before we kind of dive in, because I think it's helpful to understand that one of the reasons that people fail, myself included, this is, we all get excited because it's a new year and we're going to turn over a new leaf. And one of the reasons that people fail is they try to do too much, right? So if I'm like 300 pounds and I want to lose 50 pounds this year, as an example, then I'm going to say I'm losing 50 pounds. Well, that's hard, right? It's hard because if it was easy, you would have already done it. So you have a habit that's really hard to do. You probably have a lot of bad habits that are reinforcing it. Sure, it could be health. It could be how much you eat, could be environment, could be all sorts of things, right? But the reality is that if you want to lose weight, there's certain habits that I think we can all look at science and say this is proven to be true. Eat less, eat better quality food, exercise more, sleep more, get more water, all those things work, right? And we all try to do everything, right? Oh, I'm going to go to the gym. I'm going to go 7 times a week. But I haven't gone to the gym in 10 years. Well, that's going to fail, right? That's not a good path to success. And use the gym as an example because I haven't had to deal with the weight loss. And anyway, so let's deal with the gym thing. So if you've not worked out for like 5 years and you're going to start working out 7 days a week, that's a bad recipe, right? The better recipe would be do a little bit every day, right? Go for a 10 or 15-minute walk every single day. That's doable, right? Wake up early in the morning, go for a walk. That's a good start, right? That's a good habit to build. Do that for 30 to 60 days. If you do that for 30 to 60 days, now you can add to it. Oh, you feel good after a walk. Now maybe you should start, I don't know, maybe going for a run or lift some weights or do yoga or whatever it is, right? You add to it. But if you just start from scratch and say, I'm going to go to the gym 2 hours a day, every day of the week, you're going to fail because it's too much. We cannot change habits on willpower alone, right? Willpower is limited. I always thought I had very strong willpower. I could will myself through anything. And what I realize is that's fine if you're not doing anything else, but we all have lives and we all have other things we're doing. So the reality is that we all have limited willpower. So you can't rely on willpower. Around 2 weeks in, things get hard because your body starts to adapt and things get hard. You're like, oh, my body says, I don't want to go do this workout anymore. And then you just say, well, I don't feel so good. I'll go tomorrow, and then I'll go tomorrow, and then you stop your habit. So willpower will only get you so far. Habits will get you through the rest. And a habit, and there's a lot of science behind this, but basically, if you want to create a habit, do something small, create supporting habits, right? Like go to the gym on the way to drop your kids off from school, right? Drop them off and go to the gym on the way back. Something that is right there that you can do that makes it easier. You want to make it as easy as possible. You want to do the smallest steps possible to get through these, to get this habit change. Now, I wanted to start off with that because to me, I've just spent the last 2 weeks working through a lot of this for my year, and planning is one of the biggest ones. I'm going to actually post a bunch of stuff on LinkedIn about this, on how you can change your habits for this year. Some of it will be investment related, some of it won't, but the process is all the same. So,
Kirk, I'd
yeah,
like
go
to
ahead,
add
Doug.
on to that a little bit because we're talking about I pulled up a couple of things. Number one, I think you pointed out something really important, is that one of the biggest reasons that these New Year's resolutions fail is because people try to stop doing something, but they don't replace it with another habit. Okay. You can't just eliminate a habit without creating a new one. So as you're talking about the discipline of, if you're going to stop being overweight, you've got to replace that with a habit that actually indicates that you're going to exercise or eat better and stick with it. The Society for Personality and Social Psychology, SPSP.org, actually came out with some interesting statistics. In the 2016, they found that 41% of Americans make New Year's resolutions, but by the end of the year, only 9% were successful keeping them. 12% of people who set resolutions are successful, even though 52% of the participants were confident of it. And we talk about overconfident, false bravado all the time, don't we, Kirk?
We do.
Success and failure rates over the 6 months. Okay, this is interesting. So after 1 week, only 75% are still successful. After 2 weeks, the number drops to 71. 1 month, it drops to 64. Not bad. But after 6 months, 46% of people who make a resolution are successful. But here's the thing: the people in comparison, people who have similar goals but do not set a resolution, only 4% are still successful after 6 months. So again, a resolution at least is a start of a plan, right? We talk about failure to plan is planning to fail, right? So a resolution is at least the start of a plan. The biggest reasons to fail, and then I'll turn this back to you: 35% of participants had unrealistic goals, like you talk about. 33% don't track their progress. 23% forgot about the resolutions altogether. They didn't remember that they made them. And 1 in 10 people said they made too many resolutions and therefore, like you talked about, just trying to do too much. So anyway, I thought that would be some interesting points to think about. But I guess the number one way to be successful in your resolution, don't forget that you made one.
Yeah, yeah. If you forgot you made one, maybe the resolution should be stop drinking.
Right.
Just saying.
But going in with what we talk about every day in financial, right? It's having a plan, setting a realistic goal, having a habit to do it right, and track your progress. I think that's number one right there. If you don't track your progress, you have no. I mean, imagine if your pilot didn't track the flight that they were on. would you be very confident in getting to your destination, much less surviving? Right. So anyway,
Maybe
I'll
that's
turn it
what
back to
happened in
you.
the Bermuda Triangle, Doug. Maybe they all didn't track their progress.
Well, that might be part of it. There's some things about the Bermuda Triangle that used to talk about some magnetic waves that potentially might mess up their compasses. So there might be something to that.
You know what it was? I think the world was flat and they fell off the edge. That's probably what it was.
Oh, that's right. Where's Kyrie Irving? When are we going to interview him?
Well, I want to before we get into the investing part, because that's why everybody's here. I want to kind of list the 8 secrets to success that you can implement this year if you really want to start a new habit. So one is figure out the changes you want to make. Right? If you don't know where you're going, any road will get you there. So figure out exactly what you want to do. Figure out why you want to make them. You need a strong why, right? If you had a heart attack, maybe you do want to get healthier, right? Because that's a strong why. You don't want to have another one. So that's really important. It'll get you through the tough times. Third, create a strong plan of action. Write it down. Be specific. Be realistic. Next is start small, as we talked about, right? The how do you eat an elephant? One bite at a time. Don't try to eat the whole elephant. Just start small, make little baby steps, and then move forward.
I hear elephants are delicious.
I think that's illegal, Doug. So we don't
Oh,
want to get canceled. Is canceling still a thing?
well, it's illegal to hunt elephants in America. So
Yes, yeah, I'm pretty sure I don't. Maybe that's why there are no elephants, Doug.
Yeah, you know
You're
what?
endangered in America.
Hunting them at zoos is probably looked down on. Anyway, I kid. I kid,
It's
everybody. Don't
frowned
cancel
upon.
us.
All right. The next one is use supporting habits. So these are habits that align with your other habits. So these would be, if you're going to the gym every morning, put your shoes in front of the door. So you can't open the door without moving your running shoes. Use a social structure. Do it with somebody else. Find someone else to do it with you. Actually, oddly enough, all of these things are the same as the AA 12-step program. There are four more. I didn't go through A, so I don't know what they all are, but
Kirk,
they put this together decades ago, and it's the same thing that works today. And this is how you use habit change. So I would highly recommend looking at those because whether you're an alcoholic or not, they're great ways to change habit. Go ahead, Doug.
and Kirk, watch out. You're going to get canceled by all the people that say we should be running barefoot. So, I mean, you can't win these days.
All right. Well, moving on from cancellation.
We'll figure out
um,
something by the end of today.
Yeah, I'm sure we'll get canceled in the first part of this year. So the last two is track your progress, as Doug said, and the last one is reward yourself.
Yep.
Right. So if you're going to take a few laps around the track to lose weight, you don't reward yourself with a hot fudge sundae. Reward yourself with something else. But the point is find a reward that is going to drive you, and it's think of Facebook, right? They introduced likes, and all of a sudden everybody got addicted. It's a reward. Ooh, somebody likes me, right? It's a dopamine hit. It's the same thing. If you find a way to reward yourself, that will help reinforce the positive new change.
Yeah,
All right.
Kirk, and talking about that too on the reward, I want to tee up on that. So, Body for Life was a philosophy by Bill Phillips that I think John Elway followed his philosophy. It was a really, I've seen incredible transformations from the Body for Life process. It was from years ago, 20 some years ago. But one of the things that they said in this is that you had to have an indulgent day. So one day a week, just gorge yourself, right? Because it kept your body from going into starvation mode. It allowed your body to but it also psychologically gave you something to look forward to. You have to reward yourself along the way, because if you just try to go in and make and lose the weight or get to a goal and you're miserable the whole time you're doing it, it's never going to work.
Yeah, I think that's a great point, Doug. Is that change is hard. It's hard. It's challenging. It's supposed to be hard because we've created these habits. Somebody explained this to me years ago, and I thought it was a great mental model to use. Is your brain creates habits by reinforcing the neural connections, right? So you know how to walk, you know how to breathe, you know how to throw a baseball, whatever, because you've done it over and over and over again. So your brain creates these wirings that the more you do it, the better you get, and the more natural it is, and the less you have to think about it, right? So think about walking. You don't think about walking because you just do it. You've done it so many times. But I'm sure when you were a little baby, you were thinking about walking to some degree. So all of your habits, the more you do it, the less you have to think about it, and the stronger the connection is in your head. So somebody explained it to me this way, is that you have these neural connections, and when you do something, it's like wrapping duct tape around it. The more you do it, the more duct tape you create. So effectively, it makes it stronger. So the more you do it, the stronger it makes that connection. So that's why you can't just do something for a day or two and expect it to continue. You have to keep doing it over and over and over again until it becomes a new habit. Now, if you're eating junk food and soda and McDonald's every day, and hopefully I don't get sued for that, but if you have all these bad habits, right, and all of a sudden you want to become Arnold Schwarzenegger, that's not going to happen overnight, right? You have to do one thing at a time, right? Go for a walk, right? Maybe that's the one thing. Or maybe you're eating a lot of junk food. Give up soda, right? Just don't give up anything else. Just start with soda. And I'll tell you, when I was 7, I would say I was addicted to soda. I had ADD, ADHD, whatever they call it nowadays. I was hyperactive because I had so much sugar.
What was
I
that,
stopped
Kirk?
drinking.
I forgot what you just said. Sorry.
Yeah.
I wasn't listening.
No, that's all right. That's all right. So hopefully other people are. So if you got, so I stopped drinking soda at 7. It took me months of like this fiending. Like I needed soda. And thankfully my parents didn't leave any in the house because I was fiending for soda. And I just needed it. You could feel physically like that need. I was 7. I can still remember it. I had this like physical withdrawal symptoms from not drinking soda. But once I had done it for a bunch of months, I actually didn't want it anymore. It was disgusting. Like I think I tried it a few years later. I'm like, oh, this stuff's gross. But the fact was is I had taken myself off that addiction. And it is addictive for a lot of people. Maybe not for everybody, but for me is, some people are addicted to foods and they make foods addictive. That's deliberate. I feel like we're going down a conspiracy track here today, Doug, but flat world, food conspiracies, but I've actually spent a lot of time in my life about this. So I know a lot about it, and I call it health mindfulness. Is that each one of us is different, and you have to really be mindful of how your body interacts with certain foods and the good and the bad that it provides. And I've been doing this my whole life, so I can tell you firsthand, this is how I interpret it. But my wife is not, is, I understand it, allergic to foods in the same way, so she's different. So everyone needs to kind of take their own path with it. But the point is if you have any questions on it, I've got decades of experience doing this, so just feel free to reach out. But the point is a lot of foods are addictive and they're hard to get off. I was addictive to soft batch cookies. My mother would hide them. I'd grab one and say, I'm only gonna have one, and then the whole batch would be gone. I just couldn't stop myself. So, that is a real thing for a lot of people, not for everybody. But anyway, the point is it's addictive, and addictions are hard, and you have to be mindful of your addictions. Thankfully, mine are food and nothing worse, but other people have worse addictions. Anyway, moving on. If I don't want to make this a personal growth finance podcast. So I want to talk about predictions for 2023, because that's why you're all here, right? You want to hear my predictions. You want to hear Doug's predictions. I'm just going to say this. My first and number one prediction, and I guarantee it's going to be right. That's right. I said the word guarantee on this show. I guarantee my prediction is going to be right. My prediction is everybody's predictions are going to be wrong, including my own. Now, I want to talk about this because I think we all get baited into this issue. And the issue is we want somebody to give us the answer. We want someone else to tell us what to do, right? We're all leaders and followers in our own lives. And if you think you're a leader, you probably are, but you're also a follower in other ways. You just don't realize it. We all have this part in our brains. We all want to be told what to do because it's easier, right? We just talked about habit creation. It is easier to be told what to do. Now, giving a prediction of what's going to happen next year is somebody telling you what to do. Now, do they know the future? Doug, do you know the future?
Hold on. Let me go to the future and I'll come back with my time machine and let you know.
Exactly. I don't have a time machine. Doug doesn't have one. We don't read tarot cards. Maybe Doug does. I can't speak for him. I
They're
don't
kind
read
of
tarot
pretty.
cards. Yeah,
They're
they're kind of
colorful.
nice. I like them once in a while. But anyway, so we don't read tea leaves. We don't have crystal balls. No one does. But yet everyone's out there telling you what's going to happen in the future. Well, here's the secret. No one knows, right? Wall Street lives on telling you predictions that they have no idea what's going to happen, right? So we all have this mental framework of wanting to know the future and having somebody, I'm from Boston, somebody who's wicked smart telling us what's going to happen, right? And no one knows. And some people are famous for this. I remember as a Byron Ween back when I was starting out, we had these 10 predictions for the year and everyone used to follow him and it was like famous and he'd get one or two right and be like, oh, he was right. Like he gave 10. You could flip a coin and be right 50% of the time. Why did he only get one, right? But the point was, and I don't mean to knock on the guy, he's a very smart guy, but the point was, is everybody does this. Every firm will give you their predictions. Every investment strategist, every investor, portfolio manager, they're out there giving you their predictions because that's what you want to hear. So they're giving you what you want to hear. You're like a rat in a maze who's getting baited with cheese. We all do this. This is part of being human. And we're pointing this out because we want you to understand it, right? So we're going to give you our predictions because, it's just what you want to hear. But I'm telling you up front, they're probably not going to be right. And no one else is either. That's why we don't tell you what to think. We tell you how to think. And I'm telling you this first because we want you to know how to think about it, right? So when somebody says, oh, the stock market's going to go up this year, or it's going to go down, you're naturally going to gravitate towards the fact that, oh my God, it's going to go up. I better go all in. I don't want to miss out. Or it's going to go down. I better sell everything and go to cash. That's the wrong way to look at it. If you're not actively involved in your investing, then you're really screwing yourself over. right? You're doing yourself a disservice because you're not thinking about investing. And investing is hard, right? It's not easy. It's not meant to be easy. If it was, everyone would make money, right? And these hedge funds wouldn't be spending $100 million on research to get a leg up on everybody else. And Doug, you, I, and everyone else out here, we don't have that kind of budget. And maybe some people do, but most people don't. So we're basically relying on our own, due diligence and research and intuition, and or finding somebody who's really smart to follow. But the reality is some of those smart people aren't going to tell you what they're really doing, especially hedge fund managers. George Soros is notorious for this. I remember in 2011 or 12, he was saying, you got to short the euro. Everyone's got to short the euro. It's going to zero, and whatever he was saying at the time. Come to find out, at that very moment, he was buying the euro because he thought it had hit an inflection point and was going to go the other way. And lo and behold, it did. Everyone sold it to him. Everyone was selling and he was buying. So he was able to get into a position that he ordinarily couldn't get into because he was buying what he needed more sellers. The point is you never know what's going through people's minds. I mean, we don't do that. I'll just tell you flat out. We're fiduciaries. We don't do that. It would be unethical, illegal, immoral for us to do that. But even then, I wouldn't do it because it's not the right way to do it. It's just, there's no reason. I have this philosophy: you can't bring some people up by pushing other people down. So why would we push other people down so we could make ourselves richer? That just seems stupid to me. And I know Doug agrees, but but I think we need to, before we kind of give our thoughts on the year, I just wanted to lay that out because it's really important, right? You need to go into this thinking differently about the new year. And sorry to spoil everybody's plans and thinking that we're going to tell you that, the holy grail of what's going to happen. But if you understand, if you understand how to think about it, I think you're going to have a lot more success this year because you're going to see through the curtain of lies that everybody is inadvertently telling you. And they're not deliberately trying to deceive you. A lot of people are trying to help. But I don't think they realize the framework that they're giving you is the wrong way to look at it, which is why we do things differently on the show. And that's why a lot of you are here, because you want to think differently. You want to be more successful. And this is the path to success. So before we kind of dive right into the charts here, Doug, what are your thoughts?
Well, I think the world of podcasts and direct media has changed this a little bit, but people still listen to a lot of terrestrial television for their news, and we talk and information. We know that you could see the numbers of Fox and MSNBC and these morning shows. Something you need to remember, you need to be aware of. Okay. And I knew some people that were very deeply involved into the investment wealth management industry, and a lot of them up in your neck of the woods, Kirk, because a lot of the biggest shops are based out of the Boston area. Okay, so they would get these calls and say, "Hey, we need you in New York tomorrow morning." Okay, this is because, of course, that's where the terrestrial television broadcasting studios are, and they said, "We need you in tomorrow morning." 4 a.m. I'm making that number up, but they would tell them to come in. And so they would come in and be a room full of all of these analysts and smart guys from all of these different investment firms. And they'd interview all of them and say, all right, what do you think? What's going on? Okay. And then what they would do is they'd come back and say, all right, we don't need you. We just need you too. Here's what they were looking for. They picked the person who had the most extreme view on one side and the person that had the most extreme view on the other side. And that's who they put on air, because there is only one thing that even in the podcast world, although, like I said, people kind of have the freedom now to create and say whatever they want on it. But the reality is it comes down to one thing: subscribers. And subscribers means listeners to terrestrial television or podcasts, and that leads to advertising. They are trying to sell advertising. They're trying to make their money by the number of people viewing. And what gets people to view is extreme viewpoints. Okay. So don't go on these shows and get your news every morning. They can see this is the predominant thought amongst the industry of what's going to happen. These people are experts. They've also done studies that show the more of an expert is, the more likely they will continue to stick with wrong information and wrong opinions until it's too late, because they are almost too smart for their own good. Right. And now they believe that their intelligence and their PhDs and all of their accolades and their certifications are an indication of just how much better they are at this. They believe their own hype. So just be careful who you're listening to, what information you're hearing. Not only where may there be an agenda. If anybody has seen The Big Short, I mean, Morgan Stanley had an agenda. They owned way too much real estate to be able to think or look at the data of what their own internal team was telling them was going to happen with real estate. They were betting against themselves. That's the reality. There's agendas out there, but there's also showmanship. And a lot of what you hear and see is there to entertain you. A lot of the people that you now listen to, they are no longer professionals. They actually file their tax returns as entertainer. Okay. So just be careful what you're listening to, because a lot of it is not a place to turn to get guidance to make your next move.
Yeah, those are good points, Doug. And I want to talk about one more concept before we get into some of the charts here, is the term cognitive dissonance. Now, what you were talking about is cognitive dissonance. And the way cognitive dissonance works is it's a human trait. So it's something that we all do. And the more you know about it, it's not going to make you any less likely to fall into it. It's how your brain works, right? Cognitive dissonance and here's what it is. As you said, Doug, and I'll give you a good example. If you spend your whole life believing a certain thing, and you've put your heart, your blood, sweat, and tears into it, and let's use an example: the Shakespeare conspiracy, right? People thought Shakespeare was some poor guy who just happened to be really bright and just so happened to make all these great works. Well, there's some evidence that came out and some good interesting theories that he was actually from royalty. And he was using a pen name as Shakespeare, but he was actually royalty, which makes more sense. All the things that he was writing about, it was hard to really understand unless you're from, unless you're from the higher classes at that time. And so it made a lot of sense. But there were professors and academics that spent their whole life talking about who Shakespeare was and putting their whole career on the line, saying that he's this person, and then come to find out that he could be this other person. Well, instead of looking at it rationally and say, that's really interesting, that's a really good theory, let's look into that, they said, no, that's a fraud, it's a conspiracy, this is all bogus. And they fought against it, and they fought against it hard. And it comes down to two things. One is cognitive dissonance, right? Which is when you come up with evidence. So you have a worldview, right? You have a worldview that the sky is blue, right? And then somebody tells you it's actually red. No, I'm looking at it, it's blue, right? And then they give you plenty of evidence that it's actually red. What you'll do is you'll end up fighting back harder because your brain doesn't accept it, because you've it's part of who you are, it's part of your identity, it's part of your belief system. And this applies to politics too, right? It's why people will never change their mind, because when people have a belief system and then somebody says, well, actually, here's what happened, right? You look at politics, oh, here's what happened. Oh, well, they just fabricated that. That's all bogus. They made that up. Well, no, here's proof. Here's proof that happened. No. That's fake proof. That's fake news. And so people come up with all of this support that they create out of thin air to support the fact that it's going to break their fragile ego. So part of it is ego. We talked about the Shakespeare conspiracy. Part of that is ego, right? If you wrap yourself up into something and it's your identity and then it's disproven, part of it's like you're just shattered your ego. But part of it is just your brain works this way, in that when you see conflicting evidence from what you truly believe, you will reject it. And not only will you reject it, but you'll go harder against it than than anything else. So what you need to understand about cognitive dissonance is this affects your brain. It affects everything that we look at. So if you think, and this, I'll give you a good example, gold bugs, right? Gold bugs think that gold is the best thing in the world, is always the best thing. You always need to hold it. The world's going to end and you need gold, right? I hear this all the time. People come to me and say, oh, I want to buy gold in my IRA. Great. We can help you do that. But, we had one guy say, oh, I want to put 100% of my retirement account into gold. I said, I'm not going to do that. Like, I will happily put gold in your IRA, help you do it. But 100% is the wrong way to look at it. And I explained to him in excruciating detail. I said, look, I've been doing this for a long time. Gold is a great thing to have in portfolio, but nothing is something you put 100% of your retirement account into. Nothing. I would never do that with anything. Why? Because you could be wrong. You could be horribly wrong for many different reasons that we don't understand. Maybe an asteroid hits the planet and it's 100% gold and it destroys the gold market. So your gold goes from, like, 1600 down to 200. That would not be a happy retirement, right? And I'm not saying that's going to happen. I'm just saying you never know what's going to happen with any one thing. That's why diversification is important, because you could always be wrong, because there's so many reasons you could be wrong. But the point is that um, as we're looking at these theories, so like gold bugs, they will never change their mind, and you give them evidence that they're wrong, and they'll just come up with some other theory, or they'll fight you, right? They'll combat you. They'll say, "Oh, well, you just don't understand," right? And I understand more. I'm like, "Well, you read this from a newsletter." And the newsletter, you don't even know the guy. You read one newsletter and you're convinced that this is correct. Yes, because the guy was influencing you. He was very good at persuasion, and you read it and you're convinced. That's the whole point of the newsletter. And I'm telling you, I don't have anything to gain or lose. I don't even know this person, and I'm telling you, it's not the right thing to do. And people do it anyway, right? Because they're convinced, and they've set their identity as, I'm a gold bug. They don't say this, but effectively in their head, they're thinking, I'm a gold bug. This is how I see the world, and everyone else is wrong. So be aware of cognitive dissonance. It affects everybody. Whether you know about it or not, it's still going to affect you. You might even know it's happening and it's still going to affect you. I might say, I'm going to do this one thing to you and it's going to cause cognitive dissonance. You're going to say, oh, good, I know about it. It's never going to hit me. It's still going to hit you. You're going to feel it happening as it's happening. It's a weird thing. So I highly recommend, if you don't know about this, learn about it. It will change your worldview on politics, on investing. It will help you see the world much more clearly. Just understanding this is one concept of how your brain works. So I just wanted to touch on that before we kind of get into our predictions for the year. So I just wanted to kind of lay that out. So let's kind of dive right into some charts here. And for those of you who are listening, I will try to explain it. But go to the YouTube channel, go to the website, you'll see all this, and it can help you walk it through. So let's kind of dive right in. So the first one I wanted to show is global inflation. Now, Doug, you know what's going on in the world. How does this appear to you?
Well, global inflation to me sounds like, I mean, when I look at that chart, I'd say as much pain as that we're feeling here in the United States, we got it pretty good, because the rest of the world right now is in a very, very dire situation when it comes to inflation. And that has extreme global impact. And I think that's something we need to really be, if anything, it's not just your money that, that leads to concern on this. I think the destabilization globally is a major factor right now that and I think that, and we're going to talk about this in another one. I think some people have some really good insight as to the impact of of what's going on in the destabilization. But the reality is, right now, if your money can't buy basic needs, if things have gotten to the point where food, clothing, water, shelter are too expensive, energy to heat your homes are too expensive, you effectively destroy the middle class. And what has happened over the last 20 years is that we have seen an incredible advancement of the middle class globally. Now, I know there's a lot of debate on whether or not the middle class in America has grown. I think that a lot of people are concerned about what's happened in our local view of the world and the middle class, but over the rest of the global economy and what a lot of these developing countries, the rise of the middle class has been a tremendous positive, across the planet. But we are looking, and when you look at these numbers, when you look at this image, when you look at what's happening there, you're looking at the potential of wiping all of that advancement out in a very short period of time.
Yeah, I think this is really important, and this shows. Then the chart basically shows global inflation. It shows each country what their inflation rate is, and if you look around the world, the U.S. is actually one of the lower. on the lower part. China, I think, is the lowest at 2%.
Do
And
we believe anything China puts out, though? I mean, again, there's
no.
a lot. Understand with China, to anybody listening, there is probably nobody in the world that has more currency manipulation than China. So read into that with a little bit of jest.
Yeah, but here's the takeaway, right? Because I look at numbers all the time, and numbers can lie, right? And Doug just brought up a great point, right? People generally don't trust the numbers out of China because they're managed, and frankly, from what I understand, they're told what their target number is. So magically, they hit that, right? Because the incentive is, hey, we hit our target number. And maybe they do it in a good way, or maybe they make it up. But the point is the numbers are not necessarily accurate. In the US, they're more accurate, but they're still inaccurate because they're being managed in other ways. So none of these numbers are 100% accurate. So I don't look at them for the decimal place and say, oh, it's up 10 basis points and this is what it means. I think numbers, the larger data set you get and the more people involved, the more likely there is to be errors, right? And it's not necessarily manipulation, but it's just people are people. They make mistakes. So um, and that comes in two forms. One form it comes in is the data, is it accurate? And the other form is the calculus correct, right? So they're taking, let's say, 5% in used car prices. Is that the right number? Maybe it should be 2, maybe it should be 10. I don't know, right? So all of these things, it's less important what the actual number is. It's more important to what the trend is, right? So we look at the trend of inflation in our country, right? It was in the low twos, and then it went up to 9.1, and now it's down to 7.1. Okay, that's the trend, right? I don't care if it's 7.1 or 7.2, but I care that it's dropping from the 9.1. And we talked about this. We'll talk about it a little bit more here, but we talked about this in the show. One of the predictions this year is that U.S. inflation is going to start dropping more. I think that's the reality. It's not going to continue there to 2%, right? I think we get to the 5 or 6% range. When I say six, I don't mean high six. I mean low six. So you're looking at really the 5% up to 6% is probably where we'll end up at the low end. That'd be my prediction. That's withstanding any sort of one-off event, and who knows what's going to happen in Russia, Ukraine. But the point is that you have to look at the trend. Where's the trend going, right? And that's what you want to follow. Now, if you look at this chart, you'll notice that, with exception of China and a few other countries, U.S. is one of the lowest. But then you've got the notable Venezuela and Zimbabwe, which are in triple digits. But if you look at Europe, most of them are in double digits, with the exception of France or Spain. I think all the rest are more or less in double digits, and that's not good, right? And so you have to look at, is this something that's going to continue, and how is it going to impact that part of the world? So I've long thought that most developed countries outside of the U.S. in the last 10 years are problematic. Every year people say, "Oh, Europe, it's getting so cheap, it's going to turn around." Really? What's the catalyst for that? What's going to cause Europe to all of a sudden rebound and skyrocket in the stock market? I just don't see it, right? I just don't see a catalyst. And I'm sure there are going to be some catalysts, and I'm sure if it gets knocked down enough with the Ukraine-Russia war, I'm sure, there'll be some good buying opportunities. But the point is, I don't see growth there. I see stagnation. We've seen stagnation for many years. It'll go up and down, but it's basically going sideways, which is what I expect the US economy to do in the next 10 years as well. I expect a lot of stagnation. It'll go up and down, but it'll pretty much go sideways, just like it did in the early 2000s, just like it did in the 70s. You see a lot of volatility, but effectively, if you take that 10-year period and you look at start to finish, it's basically gone sideways. So that's my prediction, is we're going to continue along this path of stagnation, which doesn't mean we're going to have a flat year. It just means that we're going along this path for the next 10 years, is we're going to see stagnation. Okay. Now, this year, I think, is going to be an interesting year in that we've seen a big sell-off. It was down 19.4, I think, on the S&P, if not mistaken, for 2022, which is a terrible year in terms of stock market pricing. But I think that throughout the year, it'll probably end up going lower. And this isn't a two-handed economist kind of view. It's going to go up and it's going to go down and sideways, but not necessarily in that order and all at the same time. What I'm saying is, I think that the trend is still going to be down, and I would say depressed in large part because interest rates are still rising. And we're going to go into another chart about the money supply, but the interest rates are still rising, and inflation, while dropping, it's still above interest rates. So as long as the Fed is raising rates, it doesn't lead to a good sign of the stock market going up. It really means that more likely than not, the stock market is going to continue going down. And we haven't even hit a recession yet. And the Fed is trying to destroy demand, as they call it. I call it a recession. They're trying to create a recession, which slows demand. And we haven't gotten that yet. Maybe we have. Who knows? It depends on who you're asking about for the definition. But what I'm trying to say is that we are still not at the point that the Fed is driving us, which means there's more pain ahead. Now, does that mean the stock market's going to go to zero or it's going to drop 50% next year? No, I'm not predicting that. I do think in the next 5 years that the stock market will go down 40 to 60% from here. That is a prediction I'm making because I don't see how it can't. Based on everything that I'm seeing, as long as inflation stays high, which I do expect it to over the next 5 to 10 years, I do expect high inflation. As long as that happens, the fundamentals are going to change in our economy, and the companies, the economics that you used to be able to get away with prior to 2022, you can no longer get away with because it costs more to borrow money. Companies aren't going to be able to sustain themselves in life support because of cheap money. And we're going to see a lot of pain in the stock market and the economy. And we need to be prepared for that. I just I wanted to let Doug talk a little bit, but I think that's a really important framework to come away with for 2023. And frankly, for the next 5 years, is that you should be expecting volatility. You should not be expecting that the stock market is going to bottom out next month and all of a sudden skyrocket for the next 10 years. We're not going to see that. We saw one of the biggest bull markets we've ever seen in the stock market, and it's over. And people need to get that through their head. We talked about cognitive dissonance earlier. If you think tech stocks are the next biggest trend, I mean, Kathy Woods is a good example. She loves the trend. She's investing. She's betting her whole livelihood on it. I think it's great. I think the trends could be very strongly in the favor she's talking about, but it doesn't mean the stocks are going to continue to go up in the way that people expect, the way they're used to. I think that dynamic's going to change. I don't think tech stocks are the place to be for the foreseeable future. I think the fundamentals are changed. Value is going to be the place that is going to outperform as it did last year. Value is going to be in favor as long as interest rates are high and going up. Is when interest rates start to decline, the Fed starts doing quantitative easing again, you might want to go back into tech. But as long as that's not there, I wouldn't touch tech. I think that is the lever I would look at for whether you invest in tech. So if you think tech's cheap and you think it's a great time to buy, great, that's up to you. I wouldn't touch tech until I start to see the trends change. And the trends would be the Fed lowering interest rates getting cheaper, inflation dropping a lot more than expected. And I don't see that happening either. So that would be my prediction around that so far. I actually want to make one more point before I give it to Doug. Doug talked about international inflation. The reason China is at 2.1%, whether you believe it or not, is for one reason. China had really high inflation for the last 10 plus years. Why? Because we were outsourcing our inflation to them. And I don't want to go into an economics lesson. We talked about it before in the show, but we're outsourcing our inflation to them. Now we're insourcing our inflation back to us, which means we're taking it away from China. So China went from like 7.5% on average inflation down to 2%. That's because we're no longer outsourcing our inflation to them. So their inflation is a little bit more normal and is if anything, is going to deflation over there. But, who knows at this point with those numbers. But I just wanted to point that out because that is an anomaly. But that's the reason, because we were outsourcing and now we're not, which is why their inflation is lower. So any final thoughts on this, Doug, before we move into our next one?
Well, yeah, I think just to kind of tack on where you think things are going with the market. So there is two different types of markets. There's secular markets and cyclical markets. These are main broad categories. Of course, there's more than that. A secular market comes from the Latin term saeculum, which means long periods of time. So think of a secular market, whether it's bull or bear, meaning a longer trend. So not to get us canceled again, Kirk, but let's stay on it. Climate versus weather, right? I mean, I thought one of the interesting shows that I watched was kind of the reboot of Cosmos, and in it, one of the the gentleman that runs it, the astronomer, I forget his name. It's
Carl
not coming
Sagan.
through. No, the new one. He's on everything these days, but I'll try to remember it. But anyway, he was walking along a beach, okay, and he was kind of walking in a singular direction, and he had a dog on a leash, and the dog is running back and forth and back and forth and back and forth, and he basically said, "I'm climate, the dog is weather." Right? Weather can change. Weather goes up, goes down. It could be all over the place. But what does the long-term trend indicate in terms of the directionism? So I'm not going to get into whether or not there's climate change. I'm not going to get us canceled. But if we go back to the markets,
you can try. I don't mind.
Hey, it might free up some time in your busy schedule, Kirk. But if we take a look at secular versus cyclical markets, okay, secular markets, and what did the market do over an extended period of time? So there has been since pre-1900, there has been 5 major secular bull markets. Okay, there was one that started right around 1925 and went to around 1929. It started around 1920, so it was about an 8.1 year bull market. The market was up 385% during that time. There was another one that started in the 1930s for 4.7 years, up about 280%. Then we had a really long-term one that started in the 50s. What the market was 23.7 years, and it was up about 1,100%. Then we had a big one in the 80s, 18.1 years, up 1,257%. And then, of course, the most recent one, okay, that happened was about 12.7 years, with the market being around 500%. I think it's gone up a little bit since the data. It looks like the data that I'm referencing ended, September 2022. During that same period, and I'm not going to get into all the data on it, but there was basically 5 secular bear markets. And some of these lasted 21 years, as little as 3 years, as long as 16.5, 9 years, etc. Okay. What has been a pattern over and over is whenever we have had a long secular bull market, it has been followed by a fairly similar length of time secular bear market. Okay. Not exactly the same, but if it was a shorter bull market, there was a shorter bear market. If there's a longer bull market, there's a longer bear market. Okay. We just came out of arguably a 12 to 13 year bull market. Previous to that, it was about a 9-year bear market. And really, as you've talked about before, I mean, if you really want to take it the full length, 2000 to 2013, okay, the S&P 500 was negative during that time. Okay, so if you take a look at where we're going, again, not my prediction, but if the pendulum swings the way it has swung, and again, you should look at history, it tends to repeat trends. Okay, we are probably headed into a secular bear market, and very likely with the amount of growth in the market over this recent secular bull market, we're in for a lot of volatility, and probably I'm going to predict we're going to go into at least 5 to 10 years, likely a secular bear market. Now, what I also want to add on to that is that does not mean that you're going to lose money the whole time. You should just pull your money and put it aside, because inside of secular bear markets, we have cyclical markets. So there's going to be periods of time where you're going to get some growth. Let's go back to 2000 to 2013. The markets did really poorly starting out. Then they did really well for about 2002 to 2007, 2008. Okay. There was an opportunity to make money there, but there was still risk. There was still volatility that was there. Lots of problems that, of course, came to realization in 2008. And then all that goodwill and growth was given back. Okay. So over the long-term secular trend, the market lost money. But there were periods of time in which you could absolutely make money during those periods. And there were times in which you wanted to be completely to the side. So what does this say to me? I think one of my predictions is we are going, and there's still plenty of people out there to say, just buy passive indexing, passive allocation, passive market investing. I believe that while there's still I mean, certainly just saving and investing is going to help you over the long run. I think we are definitely moving back into a secular bear market, and a time because of cyclical opportunity, active investing with good active investors who are really looking at trends and managing effectively is going to be as valuable as it's been in the last 20 years.
Yeah, I would agree with that. And actually, I'm just showing a chart here, just going on your last point of active versus passive. This is a chart of the last 20 some odd years, which shows the trends of active towards passive. If you look in the early 2000s, more people were putting money into active, and then at some point, I think it was right around 2008, what happened was basically it wasn't just Vanguard people were seeing the light and saying, "Oh, Vanguard's the best path." What basically happened was in 2008, people realized no matter what they were in, they were going to lose money, and that's a problem, right? Because you'd say, "Well, active portfolio managers, but they're active. They're finding the alpha. They're finding the opportunities." No, what happened in 2008 was people realized that no matter what you were invested in, it went down. Even if it was a great company, it went down. So they thought, well, if it just, if I can't beat the index, why don't I just put 25% of my fund into the S&P 500 index? And that way I can index hug. This is what we call career risk. We actually wrote a good blog post on our website on this about career risk, which is effectively boiling it down is the upside for a lot of these portfolio managers is they beat the index and they get a little bit of a bonus. The downside, if they miss beating the index by a lot, they get fired. So the upside is a little bit of a bonus. The downside is losing your job. So there's not a lot of incentive for them to deviate from the index. So how do you hug the index? You basically buy the index, and then you buy a bunch of other things that are going to mimic the index. So what's basically happened in the industry is active managers have gone by the wayside because they're not doing anything that's adding value anymore. And I'm not saying all of them. This is not an absolute statement. There are plenty of good ones out there, but most of them they value their jobs and they want to keep their jobs because their jobs pay well. So they're going to hug the index. And people realize this, so they just figure, oh, we'll just do we'll do more passive investing because why am I going to pay 2% or 1% or whatever it is to a mutual fund manager so that they can do the same thing as the index? Why don't I just pay? And this is, Warren Buffett's point of, invest, he has this contest every year of, not every year, but frequently, where he'll bet somebody, I'll put my money in the index for the next 5 years or 10 years, and you can put your money in whatever you want, and let's see who wins. And the indexing always wins because it's really hard to beat the index. And people, I don't know what it is with this fascination. Maybe it's a gambling mentality, but people have this fascination of, I want to beat the index. You can't. Okay, it's not impossible, but statistics show that very few people beat the index consistently, and if they do, it's because they have an edge over the index. Okay, so Warren Buffett is the most famous example, and in the past 10, 15 years, he has not beaten the index. He's drastically underperformed the index. He has up until I think 2000s, and then after that, he did a poor job because of a few different reasons. He didn't do a bad job as an investor, but he just missed the boat on a number of things. And a few notable mistakes. He invested in an oil company in the early 2008 and lost a lot of money there. He doesn't talk about those, unfortunately, because he's a good PR genius. But the point being is everybody can make mistakes. He's a notable exception. He outperformed the index. There's a few others. Jim Simons, who I'd love to get in the show, but he's very secretive. He was getting like 30% a year, outperform the index. So it can be done. But for Joe and Susie Lunchbox and Doug and I, like, we can't do it because it's just the edge isn't there for most people, which is why people index. It's easier to index. You're paying less fees. I actually look at it differently. I look at it as when you're making this conversation about indexing versus not indexing, what you're really saying is, I don't have any viewpoint on time. You're operating in a three-dimensional world and not a four-dimensional world. You're looking at today and saying, well, if I look at history, look at this chart. Obviously, people see passive indexing as the place to be. People can't beat passive, so I should just be passive. You're looking at the past and you're saying, hey, it's going to be just like the future. Well, what is the disclaimer we put on everything? Past performance is no indication of future results. We're required to put that everywhere. How many people read that? Everybody reads it. How many people pay attention? Nobody. Not only do they not pay attention, but this is something I find ironic and humorous, is that we all say it, we all tell everybody, everyone hears it, they all know it, and what do? The financial industry puts out performance measures. Here's what we did in the past. Okay, what is it's not an indication of future results. So, on the one hand, we're required to say that. On the other hand, we're showing everybody, here's our past performance. It's going to be just like it is in the future. And oh, don't look at behind the curtain. I so I have a real problem with this. But anyway, it's nothing that's going to change by me. But the point is that just because passive or growth stocks or tech stocks have done really well in the past, it does not mean it's going to be the same in the future. So if you don't have a perspective of time in your decision making, you're going to make a lot of bad mistakes. So if your thought is, well, passive investing has done really well in the last 20 years, so I'm going to continue that path. Well, what if the next 10 to 20 years are not the same? Which I can guarantee you they're not going to be the same, because the past is never exactly like the future. So it's not going to be the same. So what's the best decision going forward? Well, what if I told you that the next 10 years are going to be just like the 70s or like the early 2000s, where the market basically goes up and down for in the 2000s, from January of 2000 till July of 2013, the market basically lost, I think it was 25 basis points annually over that period of time. And only after July did it actually get into positive territory annually. Would you want to waste 13 years basically making no money? Probably not, right? But if you thought passive investing was the best way to go, that would be your result. So is that the best path? Well, if we were talking, December of 2021, I would say that's probably not the best path, because the markets are at all-time high valuations on stocks, on bonds, on pretty much any asset, real estate, all of it. And somehow it's going to keep going higher. I think that's a bad bet. I think you'd be better off just sticking in cash. That would be a better bet. This year, well, the markets have gone down, so naturally they should go up, right? No, we don't know what's going to happen this year. But if I was a betting man, I would say that the stock market is still really expensive because it's not even including the fact that inflation is going to remain high and interest rates are going to be higher. So I think it's still overvalued. Now, does that mean it's not going to continue to be overvalued? No, I could be completely wrong, right? We talked about it earlier in the show. You should not follow my predictions any more than anybody else. But if I had to look at probabilities, I would say for the next 10 years, I would not be looking at growth stocks. I'd be looking at value stocks. I think that is going to be a better play. It's a lower risk, right? So, if the growth stocks are down 30% last year, value are down 10 approximately. I haven't calculated the numbers, but that's approximately where it is. Then, if I was a betting man, I'd say value is the better place to be. It's a higher probability of success. It's a higher probability of lower risk investments than in the growth sector. So just looking at probabilities, that's where I would look at it, right? And I don't know what's right or wrong, but I know that would be a safer place to be. And in many ways, that means you're looking at active managers that are on the value end of the spectrum. So there are a lot of good ones out there that have not performed well in the last 10 years because growth has been in favor and value has not. And if you were to actually do well as a value manager, you probably had to own Apple, Microsoft, Google, all the FANG stocks that did really well. So not necessarily the best place to be, but something to keep in mind as we're looking at this is that just because you've been passive and it's been successful doesn't mean it's going to continue to be successful. So always reassess your assumptions for the coming year. And pretty much you should always do this, but since we're at the beginning of the year, reassess your assumptions about where's the best place to be in the next 5 to 10 years in the next year. And just because you've created this this identity of you're a passive investor, you're an indexer, you're into diversification, that's cognitive dissonance. Don't be afraid to change your mind. Changing your mind is okay. We all have to change your mind once in a while. When the facts change your mind. So I would leave you with that. I think that's an important framework to start the year with is don't be afraid to look at your portfolio and just say, I'm going to sell it all and start fresh. Don't be afraid to do that, right? At least mentally do that, even if you don't actually do it, because it'll help you assess, all right, do I need to own this position or not? And if you decide yes, okay, then keep it. If you decide I wouldn't buy it today, then you should sell it. And that's the honest truth. That's what a lot of the professionals do is they look at it and say, would I hold it today? And if the answer is no, sell it. You know, you're not tied to a position. It's not your identity. You can be wrong. The professionals are wrong every day. So don't be afraid to be wrong. So as we kind of wrap it up, final thoughts from you, Doug, and where can people find more about you?
Well, thanks, Kurt. I think, you make a good point here, because what you're talking about at the micro level, I'm not necessarily sitting here saying that, an active fund isn't going to outdo a passive fund. I mean, it could be a, um, it could be a passive value fund, right? I don't know how an individual manager is going to outperform in an asset class. So there's two sides of active versus passive. There's the asset class you're buying. Is the asset class that you're buying into, is that actively managed or passive managed? But there's also the portfolio management side of it, right? How your allocation, I think you teed up on that. Like, if growth has been great for the last 20 years, maybe value is going to be great for the last 20 years. You need to actively understand how to adjust the portfolio for the conditions that we're facing. Okay. If we go back to the philosophy of, hey, and again, those of you listening to this may or may not be seeing this, but if you're out in social media circles, there's plenty of just buy the S&P 500. Just buy it and you'll be fine. Right. Well, just buying the S&P 500, which is still very much, if you look at what's gone in and gone out of the S&P 500 over the last 10 to 15 years, a lot of tech in the S&P 500. If tech underperforms in the next 10 years, as it has overperformed in the last 10 years, driving the S&P 500 up, you may find that over the next 10 years, the S&P 500 performs very, very poorly. That philosophy of just buy passively into one asset class and you'll be great may not end up being the results you're looking for. It may cost you because, as Kirk said, time is a very, very important. Lost time is lost forever. If you're 40 now and it takes 10 years to make money, you're now 50. You've lost all those years of growth. And the only way you can make that up is to go back and put all the money you would have made and the money that you've invested in that same period. Okay. It's not going to happen for most people. So right now, going into the next 10 years, if we go into a secular bear market, we're going to still have cyclical bull market opportunities. And that's where just buying one asset class and letting it ride may not work. I think more you're going, and I think there's been some philosophy over the last 10 to 15 years of, hey, I don't need help anymore. I can do it myself. I'm just going to buy this one asset class and look how much money I'm making. Any idiot can do it. Throw darts and you win. I'm a genius because the market just kept going up and going up and going up. If we go into a secular bear market, that may not be the reality. And getting the help of someone who, we talk about this too, right? Portfolio managers, a lot of institutional managers, a lot of financial advisors, they've got handcuffs on, Kirk. They may want to do the right thing. But when it comes down to being able to make the moves necessary with what the indicators are saying, they may have their limitations. So good active management, finding the right person that is able to make the moves necessary, that's willing to make the changes necessary that go along with the conditions we are actually facing, could be really critical if we go into a secular bear market to helping you be successful when others may not be. So that's kind of my thinking on that is making sure you got the right help around you as well. Now, where can you find more about me? We're coming into a new year. We're going to get back into it. It's a little bit early of this year, but I find that a lot of people coming out of the new year making goals. One of those goals is going to be getting your child into the right college, not paying, if you've got, not paying too much. If you've got a child that is in high school, okay, you're knocking on the door. If you wait till senior year, you're making it really difficult for you and your child. Lots of stress, lots of decisions, lots of money. Start now. It's never too late, but if you got a child in high school, this is the time to begin thinking about and putting a plan together for college. Check us out at procollegeplanners.com. With the right strategy and process in place, you could find the right college, the perfect college for your child, the college they've dreamed of, where they're going to thrive, have an extraordinary future, and you're going to get it for the right price and have a plan to not come out of college in with financial concerns.
Well, Doug, thanks again for joining us. Always appreciate your opinions on the show, and for all those of you who are listening this early in the year, Happy New Year. Hopefully, you all had good holidays, and hopefully, you have a plan set for this year to really, make the positive changes in your life that you want. Certainly, we try to do that and try to help you do that every week here on the show. Um, and I guess I'll just kind of leave everybody with. You know, think through, put together your plan of action for this year in 2023. We certainly try to help you with these different frameworks on the show. We try to put out as much content as possible. I guess the one ask I would give everybody in this new year is send your feedback. Send us feedback on guests you want to hear, topics you want to hear, things you like, things you don't like. We actually have a survey that we do in the show that helps kind of discern some of that, so we can change our content accordingly to what people want to hear. But ultimately, our job here is not to tell you what to think, but how to think, so you can make really smart decisions with your investing portfolio. Obviously, we do this, as professional money managers, but we don't expect everybody to be clients, and we don't want everybody as clients. Our job is to help the world and people think about things better. And if people want to find us, they certainly can. We're pretty easy to find, but I would say really what's important is that we have more smarter investors out there that know how to think about things, and are able to make positive impacts in their portfolio and their life. So that's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app if you're choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to our show notes, resources, and archive shows. Also, we're now on YouTube, so please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment in the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling you any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin, assuming he's still alive, of course. So please call him directly and express your feelings. If you're seeking financial advice, please talk to an oracle, a fortune teller, or maybe a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead and year ahead. And remember, no one will care about your money like you do. So invest in your life.